Hey, good morning. This is Meir Valensky with Driving Markets, driving while talking about markets. Okay, anything said in this piece is an opinion only, not investment advice, not financial advice, and it's purely to give you a market wrap, some information and educate regarding financial markets. So this week, let's kick off. Let's get to see what is driving markets this week. We'll just recap on what was driving markets last week. So Friday was a pretty volatile day. You got the Michigan Sentiment Index came out, and also you had the personal consumption expenditure. Both of them indicated that the consumer's confidence is on the way up in the United States, in the US, and that is a big boost for the economy. The markets were all over the place. They were up, they're down, they finished more or less flat on the day after being up significantly. So there's a little bit of nervousness there as where markets are going. Just be very, very clear. The equity markets have shot up significantly over the last 10 days, and they look ripe now for a serious profit taking. So we could see some serious profit taking. Overall, I think we're going to go into a very serious bear market this year. I can just see it, that 2023, with a recession, not a light recession, with a heavy recession, and with rising rates, and inflation is not going to go away, it's going to continue rising. I think we're going to go in for a major bear market. However, traders on Wall Street, analysts and investment bankers at the moment want to push the market higher, or have been driving this market higher for all numbers of reasons. Also, you've got a raft of corporate earnings coming out, mixed bag of results. But even the negative results, as I said last week, are not considered. They're made irrelevant. They're just pushed to the side or ignored. And that is an indication where traders want to push the market higher. As they push the market higher, it's an opportunity to go short, because this market is well overboard. Let's look at now what's going to be driving markets this week. You've got a massive load of results. Starting off today, you've got German GDP, gross domestic product, slightly expected to come in slightly low. Remember, Germany is going through a contraction period, as is the rest of Europe, because effectively they're going through recession with lower demand and lower sales. So expect a lower GDP figure coming in from Germany. You've also got French inflation, you've got German inflation, you've got Eurozone inflation, you've got ECB interest rates coming out this week, and you've got UK interest rates coming out this week. And on top of all that, you've got the FOMC, the Federal Open Market Committee, Fed meeting, Federal Reserve meeting, starting Tuesday, tomorrow and Wednesday, finishing off with a summary of events on Wednesday evening. So let's just tackle one of those at a time. So starting with the FOMC meeting, there's been some pretty serious hawkish comments made by some members of the Fed, especially Lael Brainard, who's the vice chair, and she stated categorically that rates will have to stay high throughout 2023 into 2024. And that a couple of weeks ago pushed markets down. Again, that was discounted by traders, ignored, and they decided to just buy into the market and push it up. So the hawkish meeting that will take place is expected to raise rates by 25 basis points. Now, that's already priced in to markets, built in, and it's probably going to happen. So it's going to raise rates. Fed fund rates are going to raise from 4.5% to 4.75%. And then the most important part will be the after rate decision comments made by the Fed chairman, Jerome Powell. That will give an indication as to where the Fed sees rates going. Now, based on the last comments, the Fed sees rates tapering off in 2023, maybe going up to 5%, maybe 5.25%. But here on Driving Markets, I'm saying that rates are going to go to 6% or higher in the US, because I don't believe that inflation is under control. I just don't accept the numbers. So could be me being blind, could be me being obstinate, but I don't see inflation under control in the US. So I expect rates to continue rising in the US. Saying that, if you look at the DXY, the dollar index, that's indicating a weakening dollar overall against the majors. In other words, that Forex traders and Forex analysts believe that the dollar may have peaked on the interest rate cycle at this stage. So in order for the dollar to go back up, which I do believe it will, I believe throughout the year the dollar is going to continue rising based on geopolitical crisis and also be based on economic news. I think the DXY index will probably reverse and start trending up, even though presently it looks like it's trending down and going to continue down. So looking at foreign exchange, I'm talking about that against the pound and the euro, then the pound expect to rise over the next few weeks up to 126, 127. The euro is going to hover around the 108.5, 109, with that interest rate decision coming in this week on Thursday. So let's just go into a little bit more detail on where we're at regarding other factors. Okay, so we've got the FOMC meeting on Tuesday and Wednesday, and then you've got German inflation coming out and French inflation. Now, German inflation is expected to come in slightly higher than expected, and so is French inflation coming in slightly higher than expected, but overall Eurozone inflation is expected to come in slightly lower than expected, and that might cause the ECB to begin taking its foot off the gas. Very unlikely. The ECB is going to continue aggressively raising rates going forward. Christine Lagarde has stated that clearly, and the rates on Thursday are going to go up by, or expected to go up by 50 basis points to 3%, with further rises throughout the first half at least of 2023 in order to taper their inflation. Inflation's running round about at the 9% in the Eurozone. UK inflation 10.6% or 10.5%, can't remember the exact figure. They've got an MPC Monetary Policy Committee meeting headed by Andrew Bailey on Thursday, looking to raise rates there by 50 basis points. 50 basis points is already been discounted, it's already been marked into the marketplace. If he does less than that, the pound is going to fall significantly. He won't do more than that, in my opinion. He just hasn't got the guts to do it. He's very, very weak chair of the MPC and really needs to get another job, probably collecting trash or rubbish for the London Borough of Barnet or whatever job he can get. But saying that, he is probably one of the worst chairs we've had as the Bank of England, but they're going to raise rates by 50 basis points. So those are big economic numbers we've got out. Then on Friday, got a massive number out, which is the non-farm payrolls, the US unemployment and hourly wages. Expecting 190,000 jobs to be created already back in the January number, as opposed to 223,000 that was created in the month before. If the number comes in higher than 190,000, you expect equity markets to go down and the dollar to go up, because that would be an inflationary indicator and the Fed would not look favorably upon that. So that number is a massive number, a lot of volatility around that number, and it's always looked at and monitored. The other thing to look at, we'll just talk about, is cryptocurrencies. Bitcoin's at 23,600. Remember, I've been saying already for a while, for more than 10 days, that Bitcoin's going to go to 25,000. It's on the way there. It's going to go to 25,000. Just have a bit of patience, and then from there it's going to be a big test. If it breaks above 25,000, then it's going to go all the way up to 30,000. However, once equity markets are sold off, then Bitcoin will be sold off with all of those high-risk assets. Overall, you've got this week some massive numbers coming out from Meta, you've got Apple, you've got Amazon, big reports coming out from the corporate earnings. All of them would be a big test as how they manage with a high inflationary, high interest rate environment. Obviously, if those numbers come in better than expected, then you see the equity markets fly. Remember, analysts have lowered their expectations, so for these companies to beat expectations, it's very highly likely. So I expect that the Amazons, the Apples and the Metas will beat expectations, because the analysts have dropped it to such a low level that it's practically impossible not to beat analyst expectations. So you can expect those shares to move up once they come out with their positive results. Could be wrong, could come out with lower numbers. Overall, I'm very bearish on Amazon, very bearish on Apple, and very bearish on Meta. I think they're going to go absolutely down, but there's a lot of manipulation going on in the financial markets. A lot of traders, a lot of hedge funds are just driving the markets higher and pulling in the money, and then I think they're going to do a massive sell-off and people are going to be burned significantly. Overall, bonds have gone up slightly. Remember, I'm calling bonds this year at 4.5% yet. That's US Treasury 10 years at 4.5% in the US. As the recession deepens, those bonds will go higher. Property is an interesting one. You got The Case-Shiller housing report coming out this week in the US, and that will give an indication on housing sales. Prices have dropped by about 5% in the US, likely to fall another 10 to 15% in the first quarter of 2023, and that will also be the case in the UK, Europe, Canada, and a few other places. Property will fall between 25 and 30% in my opinion. And that's more or less it. This is Meir Walensky with Driving Markets. You can catch me for shortened versions on Instagram, on TikTok. You can comment, you can subscribe, share with friends, etc., etc. Have a good day, have a good week. Speak to you soon.